So for the next session, that is ESOPs, the CFO's Guide to Measuring and Managing Cost. For this, I would like to call Mr. Devashish Goyal, Principal Consultant, ESOP Direct, a Qapita company. Mr. Devashish Goyal, Principal Consultant at ESOP Qapita, with over 4 years of specialized experience in employee equity compensation. Devashish is a chartered accountant who excels in equity incentive plan design, accounting, option valuation and disclosure. He has successfully advised more than 120 companies in implementing stock options, showcasing his deep expertise in field. Having collaborated with both listed and unlisted companies across India, he brings a rich blend of knowledge and practical insights. Before his role at Qapita, he developed his skills at PwC in Mumbai. Now based in Pune, Devashish is committed to empowering organizations to create effective equity compensation strategies. Can we welcome Mr. Devashish Goyal on board?
Good morning, everyone. It's my pleasure to be here in front of you all, distinguished group of people. Well, this is going to be a technical session wherein I'm going to cover ESOPs, measuring and managing cost. So before I deep dive into today's session, I would like to put a point here. Well, when we talk about a total compensation reward, in most of the major companies, they generally have one or two kind of a long-term incentives in place for the key executive. Well, the long-term incentive plan could be varied depending on the company's objective. One could be ESOP, one could be RSU, one could be a phantom. Well, the most important point here, what the management looks at is the accounting cost. Because when an instrument is given to an employee, it comes with a cost to the company. So as a decision maker, it is very vital for the management to accordingly finalize an instrument. So today in my entire presentation, I'm going to cover right starting from a life cycle of an ESOP, the valuation implications and its impact on the accounting. So first, let's try to understand life of an equity award. The first stage is a plan approval. So here an approval is required from the board and the shareholder. That is where a plan is implemented at a company. The second stage is a grant date, wherein a letter is issued to the respective grantees. This is an official date wherein the employees are eligible for stock options. The next stage is a company reporting deadline, wherein at the year end, the company needs to make relevant disclosures in the annual report. The next stage is a vesting stage, wherein whatever terms and conditions are specified in the grant letter, the employee has to fulfill all those conditions to get rights on the options that are vested. So stage 4 is very important from an employee standpoint. The next stage is an exercise stage, wherein whatever options are vested to an employee, now the employee has a right to convert these options into the shares of the company. At this point of time, there are a couple of outflows from the employee. One is the exercise price and second is a perquisite tax. The last is the share sale stage, wherein the employee sells the shares in the open market and is able to create wealth. Now, from the company point of view, if we look at the grant date and the vesting, these are a very critical point wherein the actual accounting implication comes in. So first, at the time of grant, the company computes the cost that they need to amortize over a vesting period. And the entire cost gets booked in the P&L until the vesting stage in a graded manner. Moving on to the next, here there are important terminologies that needs to be understood by us. The first is the fair market value. So basically this is a terminology that is used in the unlisted company, wherein it means the share price of an ordinary shares of the company. In India, there are a couple of commonly methods used. One is the discounted cash flow and second is the relative peer multiple. Whereas in case of the listed company, the market price where the shares of the company are traded in a higher volume is considered as the market price on the date of grant. The key difference here to understand is what is a fair value. Now, fair market value is nothing but one share price of the company, whereas fair value is per option cost that the company will book in a P&L. So there is a difference between the two that needs to be understood here. First, in DAS 102, it mandates that whenever long-term incentive, equity or a cash-based plan is given, the fair value of option is mandatorily to be done. Now, there are a couple of settlement methods in India. One is via equity and another is via cash settlement. So let's first try to understand the basic difference between the two. The equity settlement is where the employee gets the shares of the company at the time of exercise, whereas in a cash, the company pays off the entire appreciation value at the time of payout period. So the cash settlement, it hits the company reserves, whereas in equity, the market pays off to the employee. So this is the main difference between the two settlement. From the accounting point of view, when we talk about equity settle plan, so here the whatever fair valuation we have done on the measurement date is freezed. That means on the date of grant, you compute the fair value and accordingly you amortize the cost in your P&L. Whereas in a cash settlement plan, you definitely compute the cost on the date of grant. However, on each reporting date, you need to market the cost, and it could bring an incremental cost into your P&L. So whenever a plan is finalized, the management looks into how much hit it could bring to its P&L. Now, moving on is the total accounting cost. So there is a formula for that. That is nothing but the number of options granted to an employee multiplied by the fair value per option. In the next slide, we will discuss how the fair value per option is computed. And at the end, yes, at each reporting date, the relevant disclosures are required to be made. The disclosures could be on account of the scheme they have implemented, apart from that option movement, and also the KMP's disclosures are required to be made in the annual statement. Moving on to the next part here, now it's trying to understand what is fair value per option. So until now, we have discussed two important points. First is the grant date. That is when you compute the accounting cost. The second is the total accounting cost that we discussed in the previous slide, which is nothing but the options granted multiplied by the fair value. The third most important point to understand is the fair value per option. So there are three scientific models that are used. One is a Black-Scholes model, second is a binomial model, third is a Monte Carlo model. Now the key difference between these two models is, if let's say the management decides to have a performance-based vesting condition that is linked to the market base. Now what it could mean is, let's say if the company valuation reaches to X or Y, whatever number is decided, that is generally termed as a market-based condition. And as per Ind AS, it is mandatory to follow Monte Carlo model. Whereas when we look at Black-Scholes and binomial model, so these two are non-market based vesting conditions model that are generally used. Now out of these three, in India, Black-Scholes is almost used by 99% of the company. The reason is, it is very simple model to understand when compared with these two models. Now, let's try to understand what are the parameters that are important while computing the fair value per option. So in Black-Scholes, there are 6 parameters that forms as an input and that gives you the fair value per option, basis which you account the entire ESOP cost in your P&L. The first is the fair market value or current market price. So we just discussed in the previous slide what is the fair market value and current market price. That is the reason fair market value becomes important for an unlisted company to get it done by a valuer. Now the reason is, it brings transparency to the employee as well as to the investor. What is the share price of the company that was considered at the time of grant? So first is the fair market value or market price. The second is exercise price. Now in India, exercise price can be anything between the face value up to the fair market value or market price on the date of grant. It's like higher the discount that the company gives, that is looked into the exercise price. The third is the dividend yield. So whatever has been the trend of the company in previous financial years in terms of giving dividend to the shareholders is also considered as one of the input while computing the fair value per option. The next parameter is a risk-free rate. So this is basically a zero coupon yield return that is taken as one of the inputs while computing the fair value per option. The next is the volatility. So here the company's previous period's volatility is considered in a future growth model, which is a binomial model, which is a Black-Scholes model, as one of the inputs again in the computing of the fair value. Last but not the least is the life of an option. So basically, life of an option is an average of vesting and exercise period that takes into the account the value of option that the company will actually amortize in its P&L. If you look at the binomial model, one difference that it brings is it's based on the probability. That is where it is more complex for the company to implement binomial. So that is the reason almost in India you will find 99% of the companies, they have a binomial model, a Black and Scholes model in place. Moving on to the next, now let's try to understand few important terminologies that are relevant while computing the fair value. The first is the vesting period. Now as per law, the minimum vesting period has to be 1 year. However, there is no limit on the maximum vesting period. It could range from 3 years to 6 years depending again on the objective of the management. But what we have observed is generally the trend is a 4 to 5 year period when it comes to the vesting period. Why it is important? Because the total cost that is going to be booked will be amortized with a journey of 4 to 5 years. That is where it is important again how long the company will be able to take the charge in its books. Vesting becomes important. The second point to understand is the vesting schedule. Now basically there are 4 types of vesting schedule. One is an equated, wherein the options that are granted to an employee vest equally over a span of 4 years in my example. So let's say 100 options are given to an employee, 25 options vest in year 1, likewise 25 in the remaining 2, 3, 4 years gets vested to the employee. Front end vested. Now major chunk of the options that are given to an employee gets vested at the inception of the entire vesting journey. The back end vesting is where if the company wants to retain the talent, that is where most of the options are offloaded at the end of year 4. Last is a cliff or bullet vesting, wherein the entire options gets vest at the end of the vesting period. Now why it is relevant for us is when we compute the fair value per option, vesting schedule forms a very critical part. Since the cost gets booked in a graded manner, what it means is, let's say even if I am giving 25% of the options vested annually, still the company will book approximately 50% of the charge in year 1 itself. It is because of the graded manner. When compared with the bullet vesting, where the options are getting vested at the end of year 4, the company will book cost equally, which is 25, 25, 25, 25. So again, as a decision maker, it is very important how much charge you can take in year 1, because in equated, most of the cost will be booked. Moving on to the next part is the vesting condition. Well, there are a couple of vesting conditions that are involved. One is a time-based vesting, another is a performance-based vesting. So as we discussed in a previous slide, whenever there is a performance-based vesting which is linked to the market, it is mandatorily required for the company to go with a Monte Carlo model. The performance-based vesting could be divided into 3 subcategories. One could be based on the financial metrics. Again, that could be based on the achievement of revenue of the company over a vesting period, or it could be based on the net income. There is no restriction as such what should be the vesting conditions that needs to be attached. Next is the operation metrics. So here, let's say if the management decides that we need to launch a new product, as and when the product gets launched, the options gets vested to the employee. The next is the strategic matrix. So wherein, let's say if there is a business expansion in place, wherein if mergers and acquisition are looked upon as one of the vesting date, that is where the company links it with the performance-based vesting. Also, there is a practice of having a combination of both time and performance. If you will look at when the vesting conditions plays a very vital role, it is linked to the exercise price of the option. Now what it means is, if the company decides to give discount to an employee on the stock options, generally the vesting is based on the performance of the company or at an individual level. So it is important while formulating any ESOP policy, whether the company wants to give it at the market price or the company share price, then in that case it is going to be more of a time-based vesting. Yeah. Now this is a very important slide to understand what happens to the accounting cost that has been booked in the P&L over the vesting period. So let's say if the options are vested to the employee, but due to any reason the employee wishes not to exercise the option and the options gets forfeited, then in that case the entire cost that the company has booked needs to be transferred to the general reserve. However, when compared with the unvested options, the cost needs to be reversed to the P&L in that respective financial year. Now the forfeiture could be on account of a resignation or a misconduct. That is where the options are not getting eligible to be converted into the shares of the company. There is a difference when it comes to the event called as a death or permanent incapacity. In such cases, the options get accelerated immediately. Now what it means is, let's take an example. If an employee was given 100 stock options, but due to unforeseen situation, the employee passed away. Then in that case, the rights of those options are given to the legal heir or the nominee. Now, that event happened second year from the date of grant. That means 50 stock options got vested, 50 were unvested. Now, in such a case, the law says that the entire un-50 vested options will be vested immediately on the date of such event. Now, the legal heir or the nominee decides that he or she doesn't want to be a part of the company, then in that case, the options gets cancelled and the entire cost gets reversed through general reserve. Yeah, so here I have an illustration for all of you. So whatever we have discussed till now, I am going to summarize in this entire slides with a number. So it's easier for all of us to understand how numerically things work when it comes to the accounting cost. The first is the grant date wherein the options are given to the employee. In my example, I have taken 1st April 24 as the grant date. Now, as in when the options are granted, the amortization starts. So as you can see, the amortization of the cost will start right from 1st April 2024 itself. The vesting date I have considered are 3-year vesting period, wherein the options vest on March 25, March 26 and March 27. In my example, I have taken 300 options are given to an employee. The vesting schedule for the ease of purpose of understanding, I have taken equated, which is 33, 33, 34. Yeah. So the fair market value, again I have considered is 1000, it's an assumption basis. This is the fair value per option. In my example, I have taken 350, 400, 450 as an example. Now, fair value is what we discussed, that is computed using the scientific models, Black and Scholes, binomial and Monte Carlo. Fair market value we discussed. In case of the unlisted company, it is done through a registered valuer. And this is the total expense each vesting wise the company will book in its P&L. So 35,000 is for the first vesting, 40,000 is for second vesting, likewise 45,000 is for the third vesting. So there is a difference between these three vesting. This is again calculated as per the model. Now this is the amortization expense what the company will book in year 1 of vesting. Now this is a grid manner concept. So as you can see, the entire 35,000 cost got booked in the year 1 itself. Whereas for the 40,000 cost which belongs to the year 2 gets amortized in 2 different financial years. The reason is the employee has started giving his service on the date of 1st April itself. So the company needs to equally book the cost in year 1 as well as in year 2. Likewise for the year 3, 45,000, the cost gets bifurcated into 3 respective vesting period, which is 15,000, 15,000, 15,000. So in total for the year 1 P&L the cost is going to be 70,000. Which is approximately 58 to 60% that the company will charge in its P&L. So as a decision maker, it becomes very important whether the company can absorb so much of cost in its P&L considering an equated vesting schedule. As in when, if I make the changes in the vesting schedule, let's say 0, 0, 100%, the cost computation changes accordingly. Yeah, so this was more on the technical part. Now about Qapita. So basically our purpose, is to unlock the power of ownership. So we believe that when it comes to, the company's growth or the employees' wealth creation, ESOPs is one of the tools that has helped both the employee as well as the company to achieve its ultimate goal in the long run. Yeah, so here what we do at Qapita, so we help our client in set up the ESOP plan. So we provide end-to-end solution when it comes to starting from the consulting. We help our clients what kind of a plan they should implement at a company level, what should be the coverage. We try to understand all their concerns and accordingly formulate a policy for them. The second is, since the management is again very difficult because there are a lot of coverage when it comes to the employees who are granted. So we do have a platform wherein we help clients manage their entire ESOP. So we manage cap table and ESOP platform through our portal. The next is we also help our clients in terms of the valuations, the expense amortization, whatever we discussed in terms of all the 3 models, how the stock price needs to be computed in unlisted companies. That is where we help our clients in terms of recording as well, recording the entire expense. Lastly, we also help, this is more from the unlisted company standpoint, so we provide liquidity event for the beneficiaries when it comes to the ESOPs as well. So we have almost 2,000 plus customers to whom we offer our services. Out of that, 120 plus listed companies in India is what we cater to, and almost 51 unicorns. These are the clients who are with us today. Yeah, so this is about my team. So today I have with me Ekta, Prashant, Sonal and Sahana here with you. Yeah, so before I sum up on today's session, so what we have seen in the industry that ESOP in India is actually booming significantly now. And in the long run, definitely ESOPs can provide wealth creation opportunities for employees as well. And that is what as the ultimate goal for an individual as well. So we have done a survey in 2022. So if you wish to see our survey, please feel free to reach to our booth. So we'll be available at our booth to solve any concerns, whatever you have with respect to ESOPs. Yeah, thank you everyone. Thank you.
Thank you so much, Mr. Devashish. And to do the honors, I would like to call Mr. Saundir Raj from NXP Semiconductors to do the felicitation.